Up next on the SRI 360 podcast.
I can't invest in corporate bonds without doing credit analysis. In the same way, I can't invest in them without doing ESG analysis. It's almost like two sides of the same coin. There's an opportunity for us actually to generate investment performance by looking at spreads going wider for those issuers who are performing poorly from an ESG perspective. We left that meeting, if that was the message that other investors were going to be hearing, we sort of questioned whether there would be as many people queuing up to buy the debt of Saudi Arabia as Saudi Arabia may have assumed. We purchased close to $1 billion worth of Saudi CDS at 65 basis points and closed that less than a year later at a spread of 165 basis points. So we'd made a gain with the credit spread moving wider by 100 basis points. We've seen over the course of the last few years is quite a material change in behaviour in the part of Saudi as an issuer and as a country.
The SRI 360 podcast, presenting world-class investors and experts, passionate about improving the world and making high-performance returns through unique ESG, impact, and socially responsible investments. Here's your host, Scott Arnell.
Hey everyone, in this episode I am visiting with Mark Dowding, and that's spelled D-O-W-D-I-N-G, and Mark is the Chief Investment Officer of BlueBay Asset Management in London. Prior to joining BlueBay, Mark was the head of fixed income in Europe at Deutsche Asset Management, and before that, he was the head of fixed income at Invesco. Mark is a macro fixed income specialist who has been actively involved in sovereign debt ESG engagement, and he meets regularly with policymakers all over the world. So he is definitely in the flow of what is happening in the sovereign debt market and the ESG fixed income investment space. Mark began his career in 1993 as a fixed income portfolio manager after earning his economics degree at the University of Warwick. I found my talk with Mark very insightful, and I hope you will too. And now, please meet Mark Dowding.
Yeah, so a bit about myself. I grew up north of London. I joined the industry back in 1993. I'd had a gap year at university where I did 6 months of voluntary work, and I managed to write a lot of letters to different firms in the city of London and managed to get a couple of months work in asset management and enjoyed that, and consequently went back into that industry when I started my career back in 1993. I think at the time I may have dreamed of being a stock analyst. And so I was quite shocked when they put me in the bond department. At the time, I look back, there was in HR, they had a light blue file for Cambridge applicants and a dark blue for Oxford. And I was in the red for others. And because I was not quite as posh as my cohorts, and I came from a red brick university, they decided to stick me in the bond department. And initially, I may have been slightly disappointed at that. But actually, I was very fortunate because clearly, in the context of my career, fixed income has been a massive growth asset class. And indeed, I joined at Morgan Grenfell, a global fixed income team, which had half a dozen individuals and was running a few billion in assets. And by the time I left, was running 40 billion with 40 investors on the team. Saw a lot of growth and had a lot of opportunity. And certainly, I really enjoyed working in fixed income. My background is more as a macro investor. So I'm more focused on sort of government bonds. And so my day-to-day investment job is more meeting with governments and policymakers and making calls on sovereigns and on rates. And that's always been an interest of mine and a love of mine. So I'm often in Washington or in Frankfurt or in Tokyo or other centres meeting with folk there. But I guess in terms of answering your sort of first question, that sort of initial part of my career at Morgan Grenfell after I left there, because there was a bit of a political sort of change that took place in the organisation. I looked for another role. I managed to get a job as a number two on a team at Invesco, where the head of that team left shortly after I joined. And so I actually became a head of global fixed income at the tender age of 28. But I guess I'll confess and look back, it was a pretty young industry at that time. And so I enjoyed building a team at Invesco through those days before then moving with colleagues to Deutsche Asset Management, partly because Invesco was losing interest in the institutional fixed income business and Deutsche wanted to grow. But I then sort of moved across and I took responsibility for building the business head of fixed income for Deutsche. and that was out of Frankfurt. So I was working in Frankfurt for a couple of years then, a very interesting challenge, and I could share plenty of anecdotes, but eventually reached a point where I realised I didn't really want to have my family in Frankfurt and bring my kids supporting the German football team. That was beyond the pale. My family didn't want to move, and I didn't want to keep on commuting on a weekly basis. So one of my former colleagues was one of the early joiners of BlueBay. BlueBay was then looking to get into government bonds as we moved into the Euro sovereign crisis, and so had plans to build out a new part of the business. So I came across to BlueBay in 2010 and been here since and had a very happy time here, and was initially heading up the investment grade group before taking on responsibility for the rest of high yield 5 or 6 years ago, and then more recently as CIO a couple of years back.
I think you came for a title called Head of Developed Markets and Investor, or was that just a bad HR thing?
That was sort of incorporating all of high yield alongside investment grade. So it was everything then which wasn't emerging markets. So over time, I took more responsibility for more of the group. And I think the philosophy has been to sort of, when I joined BlueBay, effectively, it was like having 7 or 8 teams running 7 or 8 different strategies with their own investment process. I'd like to say their own technology. They all had their own versions of an Excel spreadsheet at the time. It felt like a real cottage industry. But after joining, we were acquired by RBC, and there was a desire, obviously, to grow BlueBay. And as I looked at it, it was something that needed a degree of industrialization and process. And so I've been on a mission to really sort of build and strengthen that platform, so that today, effectively, we've got many specialists working on one investment platform, and everything we do across all of the universe in fixed income is all off the one team, one investment process, whether it's benchmark relative funds, whether it's hedge funds, whether it's in emerging markets or in high yield or in structured credit. Everything we do is offered in a more seamless fashion. And I'm pleased to say that we've had some decent results. And so we've sort of had some nice growth in the last few years. And so we're now sort of up to around about $80 billion in assets.
You ran over a few things very quickly here that I want to go back to. So your university training, you're an economist, right? By training in economics. And that was at the University of, I'm going to say, how do you say
Warwick. Warwick.
Yeah, okay, right. And that was voted as the happiest place to live in Britain. Did you know that?
I didn't know that, but I had
Was it a happy time for you there?
Very much, very much.
The other thing that we need to get out of the way, you said you're from north of London. Who's your team? What's your football team?
I was born actually in Chelsea in London. So I grew up north of London, but I've always supported Chelsea as a club. And I go to matches as a season ticket holder and go with my son now. I was in Portugal for a week with the family, went to the final with my son and saw my team lift the trophy there, which was very special. So I felt like I'd already had my great football moment for the year. And so when I went to Wembley, I was enjoying the journey, but it was almost too much all in one go, you know.
None of your previous roles seem to be, at least from the titles, to be sustainably related or ESG related, or responsible investment related specifically. So was there some transition for you at a personal level, or was this just more where the market and stakeholders started migrating and you being a professional investor said, that's where I'm going?
Yeah, so I think that you'd observe in a way as a macro investor, effectively a lot of what you're trying to do in your role is you're trying to discern trends that are going to happen ahead of time, right? So you're always looking, and that's also true when it comes to launching products and strategies. You're trying to anticipate what your clients will be demanding in years from now, because you come up with an idea to launch a product today. It doesn't necessarily have demand today, but you want to have built a product with a track record so that when the real demand is really prevalent, you're in a position to capitalize on that. So I think the first thing is I'd say that we're in this industry, you're looking forward, you're trying to anticipate the future and read the future. And I think the thing that became very clear a number of years ago was that ESG, which I think the sustainable sort of investing theme, it always been around in the 90s and in the early noughties. But by the time you got to the beginning of the last decade, you could certainly sort of see that this was not something which was a pure niche interest on the part of a small subset of your investors. Actually, it was something that was going to become much more mainstream, much more prevalent in what you were doing. And I think the other sort of element to this as well has been the observation we had a number of years back that if you decompose the letters of E, S and G, the letter G in terms of governance, it's always been a very important factor for fixed income analysts in terms of decisions that we're making, sort of whether it comes to corporates and their ability to present true results with veracity and you can trust what you're hearing from the company management, or whether it is governments running policies in a way which are sustainable. All of these will sort of go hand in hand with credit quality and credit performance. And so it's always been a factor in what we were doing. But I think the growing realization 10 years ago was actually G has always been important and will continue to be important, but these letters of E and S are also more important, more prevalent over time. And this could manifest in the context of certain industries like tobacco, for example, being viewed as a social bad and potentially finding itself in a position where it is starved of capital, and therefore the cost of capital increases, and therefore you're more inclined to want to be underweight in a sector where the pool of available capital is shrinking over time. And elsewhere, you want to be sort of aware that there'll be other areas which are seeing a surplus of capital coming in their direction. So reading some of these trends, I think we observed was going to be intrinsic to the performance of individual issuers from a investment standpoint. And also there was going to be increasing interest in incorporating sort of ESG criteria into strategies that we managed. Now, back in sort of 2013, I mean, that was sort of signing up to things like UMPRI and what have you. But over time, it's obviously been putting in place a more sophisticated, more granular sort of framework. But at the heart of this, it's been almost, you asked what the philosophy has been, it's partly been a philosophy that says, if you are able to identify good ESG performance from issuers, that should also correlate to good issuer performance. But also having an understanding that as well as ESG being a factor that's driving investment performance, it's actually something that is going to be a factor that's determining flows of capital and client demand in different parts of your investable universe.
I know BlueBay is huge, but could you give me a high-level introduction to BlueBay Asset Management and then your specific roles and responsibilities? I know you're the CIO, but that can mean a lot of things, a lot of places, but maybe you can just drill down a little bit of what that means at such a large asset manager.
So as mentioned, we're a manager who's running 80 billion in assets. As mentioned, we're owned by the Royal Bank of Canada, RBC. All we do is fixed income. We're just fixed income strategies, and we're distributing those strategies to institutional investors or investors in what we'd call the financial institutions channel, the FIG channel. So it's largely corporate pensions and wealth managers who are, principally speaking, our clients. And in terms of our geographic footprint of the 80 billion, the vast majority of that is from European clients, and to a lesser extent, by contrast, we have about sort of 4 to 5 billion of AUM in the USA. So a very small presence in the US, a presence which is more like 6 or 7 billion in Canada through the Lincoln attachment to RBC. We've got more assets in Canada north of the border than we have south of the border. Otherwise, we have north of 10 billion in assets in Japan, which is our sort of second largest market, with the balance being here in Europe. So geographically, our focus has been more Europe and Japan. An organization. And in terms of the strategies that we manage, we obviously manage many different fixed income strategies, some of them operating to benchmarks, some of them absolute return, sort of long short, others what we call total return, which don't have a formal benchmark but have like a long bias within them. And we have these strategies all across the different bits of the fixed income universe. So we're running global products and we're running regional products. We have strategies that target corporate bonds and government bonds, and others targeting aggregate strategies where we're putting these together. But in terms of how we sort of break out our business up more formally, I'd say that we think of the total that we have of 80 billion, just north of 50 billion of that is in what we call investment grade fixed income. So high quality fixed income, both global and euro sort of based, largely speaking. Then around about 15 billion is in high yield corporate bonds in euro and global high yield in leverage finance group. Then we have just north of 10 billion in dedicated emerging market mandates. So that's another chunk of the business there, both in EM sovereigns, EM corporates, and so on and so forth. We have around about 5 billion in a business, which is a newer business for us that we've been growing in the last couple of years in structured credit, where we're managing CLOs and other strategies in structured credit. And we then have assets in things like convertible bonds, which account for a few billion, and then multi-asset credit mandates, which have the ability to asset allocate across those different parts of the fixed income universe. But the long and short of it is, if you can name it or see it or look at it in fixed income, we kind of have a product that works kind of in that space. And obviously the way that we're structured is we're running both like UCITS funds in commingled fund format, as well as lots of segregated managed accounts. And we sort of position ourselves as a solutions provider where we can sort of tailor individual mandates to individual client needs and requirements. And this is important, obviously, in areas like ESG, because what we have seen is that many different clients in many different jurisdictions have got many different sort of restrictions or ways of looking at ESG or particular sort of demands they may want to impose. And so being able to position yourself as a solutions provider, as well as having the off-the-shelf product, I think has been important to deliver as an asset manager. And to speak sort of very simplistically in terms of how we work, the way that we have tackled what we do is we're effectively decomposing all of the different assets in all the different parts of our investable universe and try to say, where can we take a decision on an element of a decision? Now, it may be a credit spread on an issuer. It may be the rates component of duration. It could be the shape of the yield curve. It could be a sector spread. It could be a currency. But you end up with many what we call alpha sources, which are decomposed in a very granular way. And then we've got an investment team of 120 individuals. And within that group of 120, everyone is taking responsibility for different decisions, different alpha sources across that big universe. And so back to my football metaphors, it's almost like I'm trying to be the manager who's organising my players all across the pitch. I don't want 120 people all just trying to take a view on US interest rates. Rather, you're trying to spread your talent so that different people are working in different areas of expertise. Because obviously to generate sort of a strong investment returns, you need to have an investment edge. And that investment edge for us is coming through our proprietary research. And so our individuals who are working in different sectors are meeting with corporate issuers and the senior management there, or they're meeting with policymakers on the sovereign side in order to discern the future direction of travel and of intrinsic within what we're trying to uncover within our investment process. And obviously ESG analysis is an important part of the analysis that we're doing on all of these alpha sources.
How many funds do you have?
We would have, if I were to add them all up, we'd have something like 120, 130 funds.
I've spoken with explicitly green bond investors, which is a lot of times where people think of with fixed income. And I've also spoken with explicitly social bond strategy investors. But as you've been describing, your approach seems to be a bit different to me in fixed income, where it's much more of an ESG approach, where you've incorporated ESG into your investment analysis. And you mentioned you've been coming down this road around since 2013, BlueBay signed up with the PRI. I might be oversimplifying this, but at least from what I've been able to ascertain, it seems like you have some funds, a segment of your funds that you categorize as maybe ESG aware, but they're not necessarily constrained by ESG factors. And then you have another group that are much more ESG oriented and maybe incorporate more exclusionary practices. Am I right about this?
Yeah. So I think the first thing to say is, again, the way that we've approached this is that we fully embraced ESG integration a number of years ago. So we're incorporating ESG analysis as a formal part of our analysis of every investment decision. So when I speak about these alpha sources, you'll see effectively 1,500, 1,600 of these alpha sources across our platform as individual investment decisions that we can make. And you can think of these as very granular components or raw materials that we can then apply to different products that we manufacture using different product designs. So this is kind of how we're working. And for all of these alpha sources, there is full ESG analysis undertaken on all of these issuers that we're investing in, a full ESG sort of checklist and an audit on everything that we do in this space, because we believe passionately about the role of ESG in every investment decision that we're taking. Now, when it comes to taking those decisions and then building products, those products are built around product designs. And so we can say that any BlueBay product is fully incorporating ESG integration within it. Any BlueBay product is adhering to a minimum list of exclusions, including things like bans on controversial weapons and the like. But then in terms of where we are imposing additional constraints, this is really more of a case of what we want to incorporate into this product design that we have. Mm-hmm. And so we have some strategies that sort of stop where I've just left it. We've just done the ESG integration. We don't have additional constraints which are embodied through to other strategies where we are imposing constraints at a sector level. So, for example, in investment grade, most of our strategies will be sort of Article 8, and here we don't have any tobacco, or the way that we rank all of our issuers on a proprietary basis is from a scale from very low ESG risk to very high ESG risk. We're formally excluding anything that screens as very high ESG risk from those Article 8 funds that we have in investment grade. So here we are imposing constraints in other areas like emerging markets, because so many of the issuers that we have as part of the benchmark actually come out as very high risk. It's actually difficult to actually have that same methodology applied to those emerging market funds, because you couldn't really manage to that particular benchmark. But here, clients have said, we'd like you to demonstrate on average if you've got a better ESG profile than the benchmark has got. So we've got sort of other requirements that we're seeking to deliver here. But then I can also extend this all the way through to what we're doing in terms of ESG focused products, where we're incorporating sort of far more exclusions, whether it's sort of Paris list and various other sort of criteria that we're signing up to in ESG labeled products, all the way through to our impact strategy, which is a true sort of Article 9 strategy, where we're obviously trying to measure the impact that we're delivering to investors who are motivated by making that sort of difference as a change. And so I think the philosophy here is we want to be able to deliver any fixed income product to any client in a way that meets their needs and requirements. We're wanting to make sure that ESG thinking is part of every investment decision, because we think that will make better investment decisions. But when it comes to the individual product and design itself, this is really a question for a client. If a client wants to exclude certain things, they're at liberty to do so. But we are aware that it's not a one-size-fits-all approach.
So if I understand you, the ESG analysis is incorporated across the board, across all funds at some level. Is that? Yeah. Did I understand that correct? So you view ESG considerations really completely compatible with your fiduciary responsibility of looking after your client's capital. It's part of it. You can't take it out of it. Essential risk, right?
I mean, I can't invest in corporate bonds without doing credit analysis. In the same way, I can't invest in them without doing ESG analysis. It's almost like two sides of the same coin. You know, you shouldn't really detach this. And I'd also say philosophically that it sort of speaks to how we've set ourselves up at BlueBay. There was a time when we started in ESG where the dedicated ESG team who are doing the ESG audits and coming up with the ESG framework that we are applying to issuers, this actually set as a separate function that reported within the risk team, because there was almost a philosophy that you were sort of thinking about ESG risk. But a few years back, we actually said, no, this is a wrong way of actually thinking about ESG. ESG is an investment function. It needs to sit as part of the investment function, be treated as an investment function, and be completely and fully embedded and intertwined within everything you're doing in the context of your investment process.
I think something that seems a bit different of your approach from others that I've spoken to is you're really investing in all bonds, or at least your universe starts out including all bonds, and you don't automatically exclude issuers.
Some strategies we do, and some we don't.
But you don't necessarily invest in green bonds. And I know you have philosophy on that. Maybe you could just summarize that for me.
So here, we've thought that, green bonds do have a place. They are sort of interesting issuance, but we think they're only interesting issues where effectively they are being used to finance projects and initiatives which otherwise would not have taken place if that issuance had not taken place. And so if we're able to sort of ring fence proceeds, if we're able to identify the projects that are being financed as a result of green bond issuance, we think that they're sort of valid investments. But when you have certain large developed countries issuing green bonds, we actually feel as if that's a real dumbing down in a disappointing way of what green bonds are, because if you're a government borrower like the UK or Germany, you could issue a green bond, but all you're really doing is you're making the rest of your issuance more brown at the same time. It's not clear to us that the green bond issuance in and of itself is actually driving you to deliver policy that otherwise wouldn't really have occurred. So to us, we think it's disingenuous. We think it sort of dumbs down the asset class. And so we've sort of spoken against it. And also, I think that the other aspect for myself as well has been that we've been concerned that in as much as you end up with green bonds, you can end up with sort of green bond indices and passive funds investing in green bonds, and everyone thinks they can do their job in terms of sustainable investing and delivering an ESG agenda by following that sort of a passive approach. But we think that this is massively missing out on the really big opportunity in ESG and sustainable investing, which is intrinsically sort of for us as stewards of capital to really use our influence in order to drive an agenda of some change, both at a corporate, a sovereign level. And so here, for me, a lot of this is what you achieve through engagement. And I think that proactive engagement is something that interests us a lot more in the context of ESG. And I'd also sort of want to emphasize as well how sometimes you can look at analysis and you can look at data, but that data is backward looking. But what really should matter more is what lays in store in terms of future behaviour. Yeah. And you see almost the delta on behaviours changing. You're seeking to reward and encourage that,
But I've understood that BlueBay uses the power of shorting an issuer to drive positive corporate behavior and change. And I guess a typical ESG fund would attempt to force change by negative screening or exclusion and essentially by capital allocation. But if I'm right, if you're doing this, you're affecting change by aggressively selling against an issuer by shorting their bond. First of all, is this true? And practically, what do you mean by this? And how are you doing this?
We are. And look, I wouldn't like to overstate our level of influence on issuers here. Ultimately, we don't own the equity. We don't have voting rights. We are able to sort of make clear our thoughts to borrowers in terms of issuer performance in ESG and really sort of articulate that we feel that if, for example, there are issuers who are paying no attention to their ESG performance and they take a somewhat arrogant approach to this, as well as having the carrot of being able to reward those issuers that are doing the right thing by buying their debt, by allocating capital in their direction. We also have the ability in a number of our strategies to actually use a stick as well as a carrot to actually express our displeasure at what we see as poor ESG performance, because we're saying that if we can identify truly bad ESG performance, we think that is going to be a catalyst for that issuer to underperform its peers. And therefore, there's an opportunity for us actually to generate investment performance by looking at spreads going wider for those issuers who are performing poorly from an ESG perspective. And I guess an example of this I can give and cite is a couple of years back, I remember we were meeting with Saudi Arabia as an issuer. And at the time, Saudi Arabia was not a very common issuer in bond markets. Saudi has always had lots of assets and lots of money and no need to raise debt whatsoever. But as reserves became depleted with lower oil prices and large fiscal deficits. They needed to tap markets, and they conducted investor meetings. And as they did, one of the things we were quizzing them about was their performance from an ESG perspective in terms of their carbon-based economy, based on their treatment of minorities within the country, the issues of women's rights and other concerns that we had. And at the time, I think it was fair to say that it felt like we were given very short shrift. We were sort of laughed out of the room. The intrinsic message was, who the hell do you think you are? We're Saudi Arabia, you're just BlueBay. Who the hell are you to be giving us a lecture? As we left that meeting, our reflection was, if that was the message that other investors were going to be hearing, we sort of questioned whether there would be as many people queuing up to buy the debt of Saudi Arabia as Saudi Arabia may have assumed. And therefore, we thought that there would be a real opportunity for the credit spread to move wider. So at the time, we could CDS, credit default swaps on Saudi Arabia, at a spread of 65 basis points on a 5-year maturity. And so we purchased close to $1 billion worth of Saudi CDS at 65 basis points and closed that less than a year later at a spread of 165 basis points. So we'd made a gain with the credit spread moving wider by 100 basis points through that particular period. So that generated a positive investment return for us. But it also led us to have subsequent meetings with Saudi Arabia as an issuer, who, in coming back, said, actually, a lot of people are talking about this ESG thing. Can you educate us a bit more? We want to listen. We want to engage for dialogue. And I think it's fair to say that what we've seen over the course of the last few years is quite a material change in behaviour in the part of Saudi as an issuer and as a country. And although I would discern that looking through my eyes, it still has a very long way to go. Yeah. Almost the delta in terms of the change in the course of the last couple of years has been quite material. It's actually gone quite a long way in quite a short space of time in the grand scheme of things. And so, having given Saudi at one point the very worst ESG rating, more recently we've actually sort of lifted it up in terms of the internal ESG score that we'd be allocating to Saudi. And so we would be more inclined to be long of Saudi rather than short of Saudi as an issuer at this particular time. So I think it's an interesting anecdote. And look, again, I don't want to overstate our influence or our behaviour, but I think it speaks to how we can identify opportunities where we can seek to educate, seek to change issuer behaviour. We can generate returns for our investors in the process. And I just think that those sort of investors who say, if something does not meet our ESG screen, we don't want to know about it, we don't want to have a dialogue, they're really missing an opportunity. We need to be speaking to carbon producers. We need to be speaking to those issuers who are the biggest offenders, because this is where the biggest opportunity is to make more of a difference, I would say.
When was that first meeting where they kind of pushed back and said, who the hell are you?
I think we're talking around 2016.
So really within the time space of 3 or 4 years, you've witnessed
we've seen quite a change, yeah.
We always like to talk about the successes at our cocktail parties. Do you have an example of this strategy where you wouldn't put it in that category?
I mean, it's in a way, it's a tricky one, sort of picking out individual examples where you would say that adopting an ESG view hasn't really worked for us. Sometimes you might say, well, it hasn't really made a difference, or it hasn't really made a difference for us yet. I think the thing that I'd speak to, and again, I was sort of interested in some of your questions. I mean, one of the things that I would sort of observe that I wish I'd have known 10 years ago that I didn't really fully appreciate at the time was how environmental factors were going to become as important as they have done. I think that maybe 10 years ago, I mean, all of us were reading the books about climate change 10 years ago and happening. But I think the thing that has been most surprising in a way in the course of the last 10 years is quite how the climate agenda has moved forward as much as it has. I guess partly in the wake of us destroying the planet more quickly than we might have anticipated. But it is an area that's had a lot more attention and certainly something that I think is going to be an increasingly important theme for us going forward. So I see the direction of travel in terms of sustainability linked investment and sort of delivering commitments around net zero and trying to set targets around the percentage of assets that you're managing being in issuers which are themselves signed up to net zero. These are some of the big challenges that really lie ahead of us. And maybe if I'd have known that sort of 10 years earlier, I think we'd have been even earlier to the market with things like an impact strategy or other such innovations, because sometimes there have been some other smaller boutiques that I've seen who have launched impact strategies who I've actually felt and known they've had less of a belief around this than we've had. And they've just been trying to cash in and commercialize something, and they've done so very successfully, because it's felt like we've been believers all along, but this is an area that we've been maybe a little slower than we have been. But that's certainly something that we've been hoping to redress in more recent times.
One thing I want to pick your brain on a little more is a significant proportion of your AUM is in sovereign issuance. And this is different than other people I've spoken to. In fact, I haven't really spoken to anyone about sovereigns until now. But I have the impression from your discussion that you're quite involved in this, and BlueBay has a good reputation with sovereigns. Can you describe how you engage with sovereigns? How do you do it, actually? And how is engaging with sovereigns different than engaging with corporate issuers? And how can investing in sovereign bonds impact a government's policy?
Yeah. So the first thing to say, of course, is that if you look at bond markets on all totality, government debt is where you actually see the biggest chunk of debt in bond markets, right? So it's not a surprise where you speak to a larger asset manager who's investing heavily in fixed income, they'll have a lot of assets in the sovereign space. We're having a dialogue with all sovereigns, large sovereigns and small sovereigns, but your ability to have, well, I'd say, more leverage obviously applies much more readily to smaller sovereigns than it does very big sovereigns. And clearly, if you have sovereigns where borrowing costs are more stressed or more elevated, they're more likely to listen to what you have to say than those where the borrowing costs are very cheap. But in the context of how we're engaging, I guess the first thing to say is we'll be meeting the issuance agencies with one-on-one meetings. They'll have roadshows, but we'll have one-on-one meetings with representatives of different sovereign issuers as they're bringing bonds to market. So we have a regular dialogue here. Secondly, that leads to ad hoc dialogue and exchange of information. For example, we write quite a lot of content at BlueBay, and policymakers are on the distribution list, and they'll ask us questions and we'll give our views and thoughts and opinions. And so there'll be an active two-way dialogue around themes that we see. And then thirdly, I'd say that where we might want to lobby, we're doing so in public media, in the press, or by signing up to bondholder groups or action groups, bring attention to certain issues. So, I mean, last year, for example, we joined a group which was protesting sort of deforestation and treatment of indigenous peoples in Brazil, and wrote an article which was in the FT on this, and we're also putting articles in the Brazilian press. On the back of that, I was sitting in my garden last year and I got a call from the Deputy Governor of the Central Bank of Brazil saying, what is BlueBay doing, trashing our name in the press? We want to have a dialogue. We're going to set up a task force to look at deforestation and indigenous people's rights. And a number of the Brazilian cabinet members were going to be part of that task force, and they wanted BlueBay to be participating on that task force. And obviously there were other stakeholders they invited as well. But it's an example of how, by taking a public position, by speaking out on issues that you feel matter, you can sort of punch above your weight, and you'll get a bit of a hearing, which will get you access and give you the opportunity to be part of the dialogue.
And what was the result in the case of Brazil? Can you point to any concrete result at this point?
Still ongoing. I mean, there's certain measures the Brazilian authorities are working on, and let's be honest with ourselves, we're talking about a big problem here. We're not in a position to be able to fix. But I think part of the view here is if there's enough pressure in the right direction, then we will see change take place over time. If we're the only voice who's trying to do this, I'm not sure we'll get very far. But the more investors are pushing this sort of agenda, the more we have this sort of opportunity to deliver this sort of change. I mean, obviously, with smaller sovereigns, some of this is, in a way, easier to affect. I can think a few years ago where Cyprus was in bother in the Euro sovereign crisis. Its banking sector had gone bust, and it was putting pressure on the sovereign, and the sovereign was needing to borrow debt. And we were saying, look, Cyprus, we'll buy your debt, but you need to clean up your banking sector. We give you a really bad ESG score because you've got a load of dirty Russian money in your banking sector. Clean up and we'll invest in your debt. Sort your problems out, clean your house, and then we'll come in and support you. I can think of countries like North Macedonia, or what you now know as North Macedonia. It used to be the former Yugoslav Republic of Macedonia. There we saw a weak government dealing with issues which were a bit beyond them, a government who understood the way that they could actually bring some more stability to their country was to sort of formalize themselves as accession candidates to the EU and embed themselves more in multilateral organizations. But the problem that they had was they couldn't actually get membership of anything because Greece blocked their application because they had the word Macedonia in the name of the country. And the Greeks would block everything they tried to do. And I remember having a conversation about what should we call the former Yugoslav Republic of Macedonia. We came up with all sorts of fun sort of suggestions as if we could sort of name a country under a naming rights sort of basis. But when the idea to move forward with North Macedonia was agreed upon, we at the time were the biggest bondholders of Greek government debt. And so we told Greece that we would dump all their debt if they carried on blocking North Macedonia, right? So again, it was about us trying to say, come on, behave yourself. We're helping you help others. And I'm not trying to, again, overstate our role in this or try and make it sound as if we're sort of punching beyond means or authority, but having a voice in these areas, I think, can matter. And the same is true in terms of the corporate bond side. I mean, like a couple of years ago, we had this horrible bridge collapse in Italy. The motorway was owned by Atlantia. And so we've been sort of working very heavily on them in terms of engagement and cleanup and restitution and the like. Or a few years back, there was the VW emission scandal. I know a lot of ESG, it was ironic, a lot of ESG funds would have been very long of VW as a very good ESG performer before that emission scandal broke. And then they would have dumped all of their debt at the wides. We had never liked VW very much, but when we saw the spreads went very wide, we sat down with the management and said, what are you going to do to clean up your reputation? What measures are you going to enact? And can we see a path that is going to lead to a stronger ESG rating? So for us, the focus is wanting to be forward-looking and using engagement as part of that sort of forward-looking element of our analysis and understanding. And I just think that sometimes some of what I see as ESG today is taking the lazy option. It's just looking for labelled issues, a label that sticks on it. Oh, someone's given that label, it must be fine. The label is just a label. Look beyond the label, I guess is our message. But again, if you care about this passionately, and I feel that you should, realise the opportunity that we actually have as stewards of capital to help bring around an agenda of change that our clients are looking for.
Is it possible to ring fence in the treasury of a country because of all the non-ring fenced use of funds, or are most of these issuance not at all ring fenced, or do you look for that or not at all?
So I'd say that in some cases it may be ring fenced, but the question is, with the green bonds, is the green issuance, even if it's ring fenced, are you financing a project which would never have taken place even if they hadn't have had a green bond issue? And largely speaking, I tend to be fairly skeptical about this. I think that most of these projects would happen regardless of whether you had a green bond or you didn't have a green bond. So I'm not sure the green bonds themselves are really playing the role that you'd want to see them play. And a lot of time, what I see is, because you've got clients who want to invest in green bond funds, green bonds will trade at a premium, lower borrowing cost than traditional bonds. And obviously investment banks will speak to issuers and say, you need to have a green bond, and you can look good by being green, and you can have a lower borrowing cost. You've got to issue a green bond. And someone says, oh yeah, that's a good idea. I'll have some of that. And then the ring fencing of any proceeds is an afterthought, and that's why I'd be a little bit damning here, partly because people are allocating green capital to those sorts of issues when that capital should be going to things that make more of a difference.
Do you really think an investment banker would say that? I'm shocked to hear this. I'm absolutely shocked.
I don't want to portray too much cynicism, but hey, look, bigger issuance cost as well. I've not looked, but someone should look. But I bet you end up with investment banks getting paid bigger fees on green bond issues than they do on traditional bond issues.
Never thought about that one. That's something to follow on. One last thing is, do you see greenwashing at the sovereign level? I mean, is this a thing?
Well, yeah, I mean, there's all sorts of greenwashing, isn't there? Because it's all about sort of statistics and data and how you report them in a light that looks good. I mean, to give you a sense of one of the things that's interesting around sort of net zero, right? And I don't know whether this has occurred to you, is that I could sign up to net zero and do nothing about it and still meet my commitments, because say if today 20% of the corporate borrowers I'm investing in have signed up themselves to net zero, I reckon even if I don't do nothing, that same portfolio in 5 years from now, that percentage has probably gone from 20% to 40%. So I do nothing and I've achieved my net zero sort of objectives by doing nothing. So there are lots of subtle ways and unsubtle ways where people will be able to claim that they're delivering a net zero target, or they are purporting themselves to be green, or within our industry, everyone will talk about the ESG work they're doing. A lot of the time, ESG isn't being done because people really believe in it. It's being done because it's a commercial imperative. You've got to be seen doing. And so you talk about it a lot, but I do wonder whether a lot of it, frankly, is kind of fluff and bullshit on the part of a lot of investors. Are they really work? To me, the acid test is, are you really engaging? Because if you're not really engaging, doing what really is your ESG work, and if all you're doing is excluding, I mean, that's a pretty trivial exercise, isn't it? Anyone can come up with an exclusion list. There's not really any science to that too much.
I'm cognizant of your time here, but I wanted to talk about your first impact-aligned bond fund. And you referred to it earlier. Can you introduce it in more detail, what it is and what you're trying to achieve with that?
Yeah, this is an Article 9 strategy that we've launched. We can see a real demand on the part of investors to be able to invest in strategies which are making a measurable difference and a change. But one of the problems with a lot of the impact bond strategies to date are they are sort of investing effectively in private markets. They're not particularly scalable in terms of what they deliver. And so they're more of a niche, and they don't really fit the needs of a lot of investors who need to invest in sort of open-ended UCITS type strategies. And so we've thought that in terms of looking at things like the UN SDGs, we can pick out specific themes that we want to be able to manage to and deliver, and then map individual assets in terms of their ability to meet and attain those themes. But for example, we've got sort of themes enabling a circular economy, or ensuring clean and plentiful water, or promoting clean and safe energy, or promoting sustainable mobility and infrastructure. These are themes that we might have, and then we're looking for individual assets that we can map to that particular theme. So that's what we're looking to do in this particular strategy. It's a corporate bond strategy. It's not managed to a particular benchmark. It's investing in high yield issuers as well as investment grade issuers, because often some of the smaller companies which are up and coming in some of these developing areas of technology, companies with less robust balance sheets, which will sit more within the sub-investment grade space. But we feel that we've built a very strong and robust ESG framework, and in terms of mapping assets in this way and measuring the output that they deliver, we have a very credible, very interesting impact-aligned strategy that, again, can meet the needs and requirements of a growing number of investors that we have. So we have some investors who are just happy with the ESG inclusion work that we're doing, and then don't want to constrain an investment universe. So they leave it for us to determine. Others will want more constraints. This is almost like an evolution along the scale. We think we'll see more strategies which are sort of transition strategies and impact strategies. It will be an area of growing interest in a growing sort of pool of capital, you know.
Did you design the impact matrix internally, or did you do it in conjunction with consultations externally, or how?
We had a lot of consultation with consultants, also with some dedicated impact investors and boutiques. And so we spent a good sort of 12 months sort of looking at how we could deliver this to make sure that it was as credible as it possibly can be, because it's a strategy that's making some big claims. And the last thing we want to do is put ourselves in a position where we're making claims that we're not in a position to support or deliver upon. And so obviously the framework was mapped out of the UN SD framework. But from that, we've then tried to hone that down into specific themes and specific assets which we can measure.
Is it possible to give me an example of one investment that you've made?
In terms of in individual sort of issuers that we have in some of the issue examples, Johnson Controls, Spectris, Reba, Kingspan, RPS, Stantec, Stericycle.
Do you expect this impact-aligned bond fund to represent the direction of travel in terms of your future client product demand?
I think that it will capture some of it. So I think that some clients in some jurisdictions will only be interested in the return number. That's all that will matter. For other clients we have, it's almost the opposite end of the spectrum. What will matter to them is more the impact or the impact as much as the return. And then you have a whole spectrum of different sort of clients in between. So I think that what we can discern is that there is going to be more capital going towards impact-related strategies, transition-related strategies. We also have a strategy in the US, which is an impact strategy, focuses on affordable housing. It's called Access Capital. And it's just that one is focused on direct mortgages. And so this is interesting to see this getting a lot of demand in the US now, as the US sort of wakes up to ESG and sustainable investment, and public funds and others express more of an interest in impact-orientated strategy where capital can deliver a return, but hopefully do some good at the same time.
I wanted to ask you about biodiversity. The UN estimates about 50% of global GDP is dependent on nature. Are you more and more proactively looking at the natural dependencies of companies and implementing biodiversity into your investment decision making?
Well, we are. It's certainly one of the factors within the framework which has received more attention in the course of the last year or two. And this really feeds into the letter E within ESG, one of the key environmental drivers. It's where we've recently added a hire as a climate specialist within the investment team, whose role is to focus on climate-related issues and issues such as biodiversity, because we can see it's something that we need to be paying more attention to. So the answer is yes, and I guess a proof statement of that is the fact that we've just made an addition to our team in that sort of space.
I just want to wrap up with a couple rapid fire questions. And so you just give me whatever comes to your mind, or you can take a pass. If you had to name the one most important challenge in the sustainable fixed income space at this time, what would it be?
I think as an asset manager, it's trying to navigate that pretty much every client seems to have a different set of requirements. It's very difficult to standardize. Different people in different jurisdictions,
And do you think we can get to standardization, or it's just never going to change and we have to be able to deal with it?
I think there may be more standardization over time, but from a regional point of view, how clients in different countries look on different industries or have different priorities, it is going to be difficult, I think, making sure that you can deliver strategies that meet the needs of all of your clients. And so your challenge is trying to position product to try and make as many people as happy as you think you can.
You don't have to name names, but can you describe to me an example of an investment you were convinced at the time you invested, ticked all the boxes, but in the end it didn't turn out? And was there a single lesson that you learned from that experience?
A great example was, I remember early in my career having investments in a bond which was linked to the company Enron that blew up in 2001, right? I had a bond called Yosemite Finance. It was a short-dated bond. It was AAA rated. I trusted in the credit rating, thought it was going to be fine, and it ended up being worth nothing, and having to explain to clients why they now had a hole in their portfolio was not a fun experience at all. And I think what that obviously was an example of was corporate fraud. But I think the other thing that sort of interests me is, again, having a robust ESG framework is something that helps you identify something like corporate fraud. I would like to think that actually having that framework, it meant that when we looked at an issue like Wirecard a couple of years ago, it sent up all sorts of red flags. We gave it a really shocking ESG score, and before we looked any further at it, we'd already eliminated it as an issue that we'd invest in, kind of thing. So that was an example of how, again, you're learning your lessons and trying to look for signals of fraudulent behaviour and incorporate that in terms of a governance framework.
I met those guys at around the same time. They filled up the conference room. I was in the process of selling a company, and they thought they were the smartest guys in the room. And my lesson was, if it looks too good to be true, it probably is. Yeah. Now, the converse of that, can you describe to me an investment that you were skeptical of? You don't need to name the names, but either at the time you invested or maybe ultimately you passed on it, and in the end it turned out way better than you thought and you were pleased you invested, or if you had passed on it, maybe you wished you hadn't.
Again, I'm not sure I got a great example for you, but I can say that I wish I'd bought some stock in Tesla a couple of years ago. I actually bought a Tesla car, and I partly as a bit of an experiment. I thought, let's see how it will work. And a month after having the car, I was raving about it. It was the best car I've ever owned, and I still love it today. And I went from being a real skeptic to a real believer in Tesla. But if only I'd have put my money where my mouth was, I probably would have paid for a car a couple of times over by now. So that's one that certainly got away.
I was speaking to someone the other day about some of Musk's technology, and his lesson was, I'm not going to bet against him anymore.
Well, you don't want to bet against the people who bet on him anymore.
If someone wants to get into the sustainable fixed income space, how would you advise them to get into the business, and what might be the best place for them or best way for them to cut their teeth?
Again, work hard, be curious, look to the future and inform yourself from different viewpoints. Obviously, there are things like the ESG CFA charter that a number of people have taken a BlueBay in terms of some of the more junior analysts who they found that to be very useful. But I think I would be flagging that this is an area within our industry which should be seeing a material amount of growth. And so that should be creating opportunities for talent just getting into the industry. So I think the message would be go for it.
Listen, Mark, I've learned a lot. It's been incredibly interesting. You've been very generous with your time. I really appreciate it.
Well, it's been an interesting discussion, and I like the way they attacked this and laid out your points, and you've clearly done a lot of research. And look, ordinarily, I would confess that I wouldn't really take the time to be part of an initiative like this, but I think the way in which you've approached this, I think, is really interesting, and I wish you every success with the response you get, and keep in touch.
I'll definitely do that. Thanks very much, and keep up the good work, and thank you for your well wishes for the project. I appreciate it. We'll be in touch.
Thanks.
Take care. Cheers.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.